When Wall Street banks talk about their outlook for 2026, nearly every forecast circles back to one central question: what happens next with the AI trade? Not just whether artificial intelligence continues to grow, but which parts of the AI ecosystem actually deliver returns and which ones start to slow down. The AI trade is no longer a single story. It has split into multiple layers, and understanding those layers is what will separate winners from losers in the coming year. One thing that appears clear is that demand for AI chips remains strong. Training models is no longer the only focus. Inference, the process of deploying AI models at scale, is becoming the real growth engine. Looking back at market performance helps clarify this shift. When comparing which companies beat the Nasdaq in 2025 and which might do so in 2026, a clear pattern emerges. Some firms that lagged behind, including Apple, Meta, Oracle, and C3, are now being reevaluated. The key question is not whether they struggled before, but whether they can adapt fast enough to the AI-driven environment that is reshaping competition. On the other side are companies that already outperformed and may continue their momentum. Nvidia, Google, AMD, Intel, and Palantir stand out as firms positioned to benefit from multiple layers of the AI stack. Strategic deals and licensing arrangements have allowed Nvidia to expand its reach beyond traditional GPS and into inference-focused architectures. This move strengthens its position not just as a chip supplier, but as a core infrastructure provider for the AI economy. However, there is also growing debate about whether large language models are delivering the same rate of improvement they once did. Progress has not stopped, but it has slowed. As models become more similar, commoditization becomes a risk. This environment favors companies that control the full AI stack, rather than relying on one layer alone. Google is a prime example of this advantage. Its ability to integrate custom chips, proprietary models, massive datasets, and real-world applications gives it a structural edge. Each generation of its AI models improves not just through architecture, but through access to data that competitors cannot easily replicate. That vertical integration is becoming increasingly valuable as model differentiation narrows. Perhaps the most disruptive trend is the rise of ultra-lean AI companies. Across the software landscape, businesses with fewer than 20 employees are producing tens or even hundreds of millions in annual recurring revenue. This is not theoretical. It is already happening. Platforms that track these companies show examples of teams generating enterprise-level revenue without traditional organizational scale. These firms are likely to become the IPO candidates of the next cycle. Companies like Midjourney and other AI-native platforms demonstrate how creativity, automation, and distribution can converge into massive value creation. The implication is profound. In the coming years, a 100-person company could realistically compete with legacy software giants, while a 1,000-person firm could challenge consulting behemoths that once required tens of thousands of employees. Traditional enterprise players are not standing still. Oracle, for example, is often misunderstood in the AI conversation. Its heavy investment in infrastructure has raised questions, but history suggests a long-term strategy. Oracle is positioning itself as a cost-effective alternative to hyperscale cloud providers. For many enterprises, the economics are compelling, with cloud costs reportedly far lower than those of larger competitors, combined with deep institutional relationships. This could make Oracle a surprising beneficiary of the next phase of AI adoption. Macroeconomic conditions also play a role in shaping 2026. A more dovish Federal Reserve could restore business confidence. If manufacturing activity recovers, traditional sectors like industrials, energy, and basic materials may see renewed strength. These areas were overshadowed by tech in recent years, but a broader economic recovery could rebalance performance. Financial services may be one of the most overlooked AI beneficiaries. Banks and financial institutions are uniquely positioned to deploy AI and blockchain to reduce operational complexity and labor intensity. As automation expands, margins could improve significantly. Over time, the most tech-forward banks may begin trading more like technology companies than traditional financial firms. Beyond the United States, the AI story is becoming increasingly global. Asia is emerging as a powerful force in the AI ecosystem. Chinese, Korean, and Japanese companies are making strategic moves across chips, memory, and storage. Stock performances in these markets reflect a rapid shift toward AI-driven growth, new IPOs, manufacturing expansions, and global customer wins suggest that AI leadership is no longer confined to Silicon Valley. This globalization also increases competition. Governments are pushing for self-sufficiency in critical technologies, especially semiconductors and cloud infrastructure. That push requires massive capital investment, which in turn drives more companies toward public markets. As a result, investors in 2026 will not only be evaluating technology, but also policy, geopolitics, and capital access. Ultimately, the AI trade in 2026 will not be about hype. It will be about execution. Chips versus inference, vertical integration versus commoditization, lean teams versus legacy scale, and global competition versus domestic dominance. The investors who understand these shifts will be better positioned for what comes next. If you want to stay ahead of how AI, markets, and global capital flows are reshaping the future of investing, make sure you're subscribed. The next phase of the AI cycle is already unfolding.